In the late 1990s, one corporation was universally lauded as the paragon of American innovation, reporting revenues that defied economic gravity. Enron seemed unstoppable, capturing the admiration of Wall Street and the absolute trust of thousands of employees who anchored their life savings to its soaring stock. Yet, beneath the gleaming glass towers of its Houston headquarters lay a financial labyrinth constructed entirely of smoke, mirrors, and toxic debt. When the illusion finally shattered in the autumn of 2001, it evaporated billions of dollars in shareholder wealth and erased the pensions of loyal workers in a matter of weeks. The Enron scandal did not just destroy a single company, it exposed a rot at the very foundation of corporate governance, demanding a forensic examination of how the brightest minds in business engineered the most devastating corporate fraud in history. The origins of this catastrophic deception can be traced back to a fundamental shift in the company's business model. Originally a traditional natural gas pipeline operator, the firm transformed into a financialized energy trading behemoth under the guidance of visionary executives who believed they could commodify almost anything. They convinced regulators to deregulate energy markets, creating a volatile new landscape where aggressive trading could yield astronomical, albeit highly unpredictable returns. This pivot required an insatiable stream of capital, pushing leadership to prioritize the appearance of relentless growth over actual, sustainable cash flow. To sustain this facade, a ruthless corporate culture was cultivated, rewarding financial ingenuity while actively punishing skepticism. Executives implemented a brutal performance review system that routinely fired the bottom tier of employees, breeding an environment of paranoia and cutthroat competition. Survival depended on closing deals and booking profits by any means necessary, blinding the workforce to the ethical compromises being demanded of them. The psychological manipulation was profound. When leadership constantly reinforces the narrative that you are the smartest person in the room, questioning the math feels like a confession of incompetence. The cornerstone of this mathematical manipulation was a legally permissible but highly exploitable practice known as mark-to-market accounting. Traditionally, a company records revenue only when a service is delivered and the cash is actually received. The new methodology, however, allowed executives to estimate the total future value of a long-term contract and book all of those projected profits on the very day the deal was signed. If a 20-year energy contract was theoretically worth $50 million, that entire sum appeared on the current quarter's income statement, even if the project later failed and not a single dime ever materialized. This aggressive front-loading of revenue created a ravenous beast that required constantly escalating deal-making just to maintain the illusion of profitability. Because the cash was not actually flowing into the corporate coffers, the company was forced to borrow heavily to fund its daily operations and ambitious new ventures. The debt burden grew exponentially, threatening to trigger credit downgrades that would instantly collapse the entire trading operation. Wall Street analysts and credit rating agencies, blinded by the steady stream of reported earnings and lucrative consulting fees, failed to question the glaring discrepancy between the stated profits and the actual cash on hand. To keep this mounting debt off the official balance sheet, the chief financial officer engineered a breathtakingly complex network of shell companies. These off-the-books constructs were known as special purpose entities, or SPEs. While special purpose entities are a standard financial tool used to isolate financial risk for specific projects, they were weaponized here to serve as corporate trash cans. The parent company would transfer its failing assets and massive liabilities into these hidden shells, magically erasing the debt from its public financial statements and replacing it with phantom equity. By capitalizing these shell companies with its own artificially inflated stock, the corporation essentially guaranteed its own debt. It was a financial perpetual motion machine built on a terrifying premise. As long as the stock price continued to rise, the hidden entities remained solvent and the debt stayed buried. But this structure was inherently fragile, a house of cards that would violently disintegrate the moment the market lost confidence and the share price began to slip. The executives had not eliminated the financial risk. They had merely hidden it in a dark corner of the ledger, waiting for an inevitable reckoning. Unraveling this labyrinthine structure required navigating through layers of deliberate obfuscation designed to defeat even the most rigorous audits. The financial statements released to the public were notoriously incomprehensible, filled with dense footnotes and convoluted disclosures that masked the true nature of the transactions. Independent watchdogs were effectively neutralized, as the very people tasked with verifying the numbers were deeply compromised by glaring conflicts of interest. The guardians of the financial system had been co-opted, transforming from skeptical investigators into active facilitators of the deception. The role of Arthur Andersen, one of the world's most prestigious accounting firms, was central to enabling this massive fraud. As both the external auditor and a highly paid consultant for the energy giant, the firm faced immense pressure to approve the questionable accounting practices or risk losing millions in lucrative fees. Partners at the auditing firm routinely overruled the concerns of their own internal risk management teams, signing off on the use of the deceptive shell companies. This catastrophic failure of independent oversight destroyed the fundamental trust that underpins global financial markets, proving that prestige is no substitute for integrity. The facade finally began to crack in the late summer of 2001, triggered by a convergence of failing global investments and a sudden, sharp decline in the company's stock price. The broadband and retail energy divisions, touted as the next engines of massive growth, were hemorrhaging cash and failing to deliver the promised returns. As the share price dipped below the critical thresholds required to keep the off-balance sheet entities afloat, the hidden debt began to boomerang back onto the parent company's books. The financial perpetual motion machine had stalled, triggering a cascade of margin calls and credit downgrades that accelerated the inevitable collapse. Amidst the growing panic, a courageous vice president named Sharon Watkins stepped forward, piercing the veil of corporate silence. She drafted a stark, urgent memo to the chairman, explicitly warning that the company was at risk of imploding in a wave of accounting scandals. Her internal whistleblowing highlighted the perilous nature of the off-the-books partnerships, exposing the reality that the emperor truly had no clothes. Yet instead of initiating a transparent, independent investigation, leadership tasked the very law firm that had approved the deceptive structures to look into her claims, effectively ensuring a whitewash of the impending disaster. The human cost of this engineered catastrophe was immediate and devastating, falling hardest on those who had no part in the deception. As the stock plummeted toward pennies, executives quietly cashed out hundreds of millions of dollars in shares, fully aware of the impending doom. Simultaneously, rank-and-file employees were explicitly barred from selling the company's stock held in their retirement accounts, trapped by administrative lockdowns as their life savings vaporized before their eyes. Over 20,000 people lost their jobs overnight, walking out of the gleaming headquarters with nothing but cardboard boxes and shattered futures. The betrayal extended far beyond financial ruin, inflicting a profound psychological trauma on the workforce and the broader investing public. Employees had been indoctrinated to believe they were part of a revolutionary family, heavily pressured to invest their own money as the ultimate test of corporate loyalty. When the truth emerged, the realization that their dedication had been cynically exploited to enrich a select few at the top shattered their trust in corporate institutions. This collective trauma serves as a grim reminder of how charismatic leadership and cult-like corporate environments can blind intelligent people to glaring ethical violations. In the smoldering wreckage of the bankruptcy, lawmakers and regulators scrambled to close the systemic loopholes that had allowed such a massive fraud to flourish. The most significant legislative response was the Sarbanes-Oxley Act of 2002, a sweeping reform designed to restore investor confidence and mandate strict new standards for corporate accountability. This landmark legislation criminalized the manipulation of financial records, required chief executives to personally certify the accuracy of their financial reports, and severely restricted the consulting services that auditing firms could provide to their clients. The era of the undisputed, unverified corporate ledger was officially over. The legacy of those complex accounting tricks continues to cast a long shadow over modern financial markets. While the specific mechanisms of the deceptive shell companies have been heavily regulated, the underlying temptation to engineer financial results remains a persistent threat. The collapse demonstrated that fraud rarely begins with a massive, calculated heist. It often starts with a single, aggressive accounting choice designed to smooth over a rough quarter. That initial compromise sets a dangerous precedent, creating a slippery slope where increasingly deceptive tactics are required to maintain the initial lie. Today's financial landscape is vastly more complex, populated by decentralized assets, algorithmic trading, and opaque offshore structures that offer new hiding places for toxic debt. The vigilance demanded of regulators and investors must evolve to keep pace with these sophisticated innovations. We must recognize that the dark arts of financial manipulation do not disappear. They simply mutate, adapting to new regulatory environments and exploiting the inevitable gaps in oversight. The guardians of the market must remain skeptical of any financial instrument that claims to generate risk-free returns or promises growth that defies economic reality. Empowering individuals to detect and report corporate malfeasance remains one of the most effective defenses against systemic fraud. The courage displayed by early truth-tellers highlights the critical need for robust legal protections and secure reporting channels that shield whistleblowers from retaliation. Cultivating a corporate culture that actively encourages transparency and rewards ethical dissent is not just a moral imperative, it is a fundamental risk management strategy. When employees are safe to question the math, the entire financial ecosystem becomes more resilient against the destructive forces of greed. The final reckoning for the architects of the deception delivered a stark message about the ultimate cost of corporate hubris. High-profile criminal trials resulted in sweeping convictions for conspiracy, fraud, and insider trading, dismantling the myth of untouchable executive privilege. The once mighty accounting firm that enabled the disaster was effectively destroyed, its reputation irreparably tarnished by the shredding of crucial audit documents. These profound consequences serve as a permanent warning to the corporate elite. The deliberate obfuscation of financial reality is not a business strategy, but a criminal enterprise. Ultimately, the anatomy of this historic collapse reveals a timeless truth about the nature of deception in the financial world. The most dangerous frauds are not perpetrated by shadowy figures in back alleys, but by highly educated professionals operating in broad daylight, armed with spreadsheets and legal opinions. They exploit our collective desire to believe in endless prosperity, weaponizing complexity to silence doubt and extract wealth. By understanding the intricate mechanics of how debt was hidden and profits were faked, we fortify ourselves against the next inevitable attempt to sell a financial mirage as solid ground.